Hi everyone, bonjour à tous. Merci d'être avec nous ce matin. Thanks for being here with us this morning for this super interesting event. First, let me thank our partner that made this event possible, Kpmg in Quebec. So thanks a lot for partnering with us for this event. For those of you who don't know me, I'm Mathieu Paquette-Lambert. I'm the Director of Fintech Development at Finance Montreal and the Montreal Fintech Station. Welcome to this Rencontre OFF Forum Fintech event. So this series of events is really to keep the community of the Canada Fintech Forum engaged all year long. So we didn't start communicating about that, but the Canada Fintech Forum will be back in a virtual format at the end of October. So you may want to have a placeholder in your calendar for that, but you will be contacted as soon as the tickets will be for sale. Before I introduce our first guest of the day, let me also tell you that we recently launched a payment accelerator, Fintech accelerator, but the first cohort will be about payments, and we are recruiting startups for that first cohort until May 23rd. So if you are fintech here today and in the payment space, make sure to have a look at what we have to propose with this program on our website. All right, so let's start with the content. That's what you are here today. So let me introduce you a longtime collaborator of Finance Montreal and the Montreal Fintech Station. It's Marc Plamondon, who's an audit partner at Kpmg in Quebec, leader, also fintech leader for Kpmg in Quebec. And Marc is also a member of the Fintech Committee of Finance Montreal. Marc, thanks for being here this morning with us.
Great, thanks, Mathieu. Thanks for having me this morning. Our subject today is around environmental, social, and governance investing principle, or ESG. And right before I introduce my panelists, I just want to give you a short summary of what the letters actually means these days in the financial institution world. So we're going to start with the E, or the environmental agenda. It's really the defining issues of our time. And this year alone, we're likely going to see new set of commitments from government across the world on moving to net zero carbon emissions. And those commitments are great, but we'll see that the hard part is how we're going to achieve them down the road. On the S side, the social side, it really emerged during the COVID-19 pandemic, and especially for financial institutions. COVID-19 has highlighted the critical role that banks play in supporting the resilience of communities. It's brought to the forefront issues such as financial security, access to financial services, and inclusion. And it's really placing banks at the crossroad of the economy and social issues like we probably never seen before. And on the G side, the governance, it means financial institutions are more under scrutiny to make sure that they're governed appropriately, that they have the right controls in place, the right driving values, and also the right leadership at the top. And now for companies, they need to have ethical policies, commitment to diversity, and pay their fair share of tax. And all that is key. So ultimately, when you think about it, the G is really, how do you prove to the world that you're actually doing what you say you are? And today's goal is to go over two topics. First of all, will be understanding where the market is going and to help fintech identify maybe white space to create new products. But also from a startup perspective, the fintechs are also seeking for capital. So to understand how the fintech itself can be attractive from an ESG investment standpoint will be something that we'll touch on. So without further ado, I'll introduce my three panelists. I'd like to invite Isabelle Giguère, Chief Financial Officer at Payment Source and member of the Investment Committee of Luge Capital, to join me. Hi, Isabelle.
Hi.
Isabelle, to introduce yourself, can you tell us a bit more about Payment Source?
Yeah, sure. Hi, everyone, and thank you for having me today. So a bit about Payment Source. We are a payment service provider focused on financial inclusion in Canada. We strive to provide a transaction for every Canadian, and we're best known for our Pay Simply site, which enables tax payments online, and also our reloadable Visa card, which is sold at all Canada Post locations. And what brings me here today, Payment Source is a socially driven fintech. And prior to that, I was also founding team member of TapTapSend, an impact-focused money transfer startup with the mission to bring the cost of sending money down to 3% or less. So I'm a strong believer in fintechs for good.
Oh, well, thanks for being here. I'd now like to invite Anne-Marie Monette, Senior Director, Responsible Investment at PSP Investments. Hi, Anne-Marie.
Hello, everyone.
Can you tell us a bit more about your role at PSP?
Sure, happy to. So thank you for the introduction. As part of my role as Senior Director, Responsible Investment, I help support our public market activities, which means really working with the asset classes and ESG integration for internally managed portfolios, and also supporting our external managers team in ESG due diligence and in manager selection, appointment, and monitoring. And another big part of our role is also to help coordinate the proxy voting and engagement process.
Oh, great. Thanks for being here. And now I'd like to introduce my colleague, Katie Dunphy, Executive Director, Sustainability and Impact Services at Kpmg. Hi,
Hello,
Katie.
Marc.
Katie, to introduce yourself, maybe you can tell us a bit more about what brought you to choose a career in sustainability and impact?
Yeah, so I started in this space probably about 15 years ago. And at the time it was very, I think, early days in the land of corporate responsibility. I was working with Kpmg in our European practice in Spain, in Madrid. And one of the things that I quickly noted was the eagerness and the goodwill from the business sector in general, to participate in and contribute to more than just shareholder returns. There was really, I think, a growing understanding of the broad benefit of paying attention to ESG factors and managing those key risks as a critical value to business and as a way to open new commercial opportunities. And so when coming back to Canada and helping to launch our national sustainability advisory services practice, that really became a focus for the work that we do in helping organizations. So on the corporate side, helping corporates to understand the meaning of ESG and how it can, again, help enhance, protect and preserve capital. And from the investor perspective, we facilitate a lot of processes as well on behalf of investors who are looking critically at these ESG factors in their investment processes.
Thank you, Katie. Okay, let's dive into the first part of our session. As you probably all read at the last World Economic Forum, ESG was a subject front and center. One discussion was about how turning words into action. And at the forum, they said that companies must address two pressing challenges. First one being measuring and reporting stakeholder practices on a consistent basis. And the other, how to embed stakeholder governance in corporate decision-making. So let's start to look at this from an investor perspective and understand how investment policies have ESG embedded. And I'm going to start with you, Anne-Marie. Can you tell us how ESG is included in the investment policy and investment decision-making process of PSP?
Sure, and very much along the lines of what Cathy was mentioning earlier. As long-term investors, PSP believes that well-run companies that effectively manage ESG considerations are more likely to prosper over the long term. So we implemented a responsible investment policy that is really overarching all the asset classes in which we invest. So in practical terms, what ESG integration means at PSP is considering environmental, social, and governance issues in investment decision and also in investment analysis to ultimately drive decision making. And that it also means, very importantly, that we are active stewards of the assets that we own, so that we engage with portfolio companies and with our partners to promote good governance practices, but also strong performance on environmental and social issues. And governance is the starting point of our process, where we seek to identify management teams and boards that have the right balance of skills, expertise, and backgrounds.
Okay, thanks. And maybe Katie, if we build on that, in your view, talking with clients, when did you see this trend started, and why the shift now to those principles?
Yeah, it's an excellent question, Mark, and one that actually has quite a bit of history. I would say, the origins, if you look into some of the literature of where really all of this came from, largely, I think, initially gained popularity about 200 years ago, when from an ethical or religious basis, various organizations were looking to avoid participation in slavery, in connections with unethical businesses, or, for example, the manufacturing of arms or tobacco. Now, fast forward 200 years, there obviously has been a lot of change and sophistication that has emerged from those early concepts of ethical or responsible investing, if you will. And we'll even add in the term sustainable, because again, that is, each of these words have, I think, fairly important nuances. But rather than, try to parse the language at this point in time, what I want to say is that on an ethical or responsible investing basis, what we're seeing in terms of trends and how that has been shaped over the past 5 or 6 years, I would say most importantly, has been the proof emerging, the data sets emerging that support the ESG investment thesis, in that organizations who pay due care to these topics and manage the risks well have, on average, better returns. And so that, just sort of as a standalone, is a great, is a great reason why this has picked up and gained momentum. I would say that momentum has hit kind of peak sprint in the last 3 to 4 years now. And that really is due to the fact that the Financial Stability Board, they convened a group called the Task Force on Climate-Related Financial Disclosure. And essentially the work of that group was to think about climate change as a potential financial market disruptor, similar to what had caused the 2008 financial sector crisis. So in order to avoid that, the work of this group was to particularly look at climate change risks and opportunities as a way to enhance the type of information that is provided to the market, so by issuers, for investors, in order to have a better understanding of the ways in which corporates are managing those types of risks. And I think that really has resonated with executives and with boards. Not to mention, it was chaired by Marc, a well-respected Canadian and former Bank of Canada and Bank of England. So I think it made a lot of sense from a Canadian perspective, finally, that these issues are not just issues that someone in the business can take care of without better integration within enterprise risk, without board oversight and executive sponsorship and participation.
Yeah, and definitely this trend is rallying the financial community as a whole. And in the news recently, I read Larry Fink, the boss of BlackRock, the world's largest fund manager. He wrote in his annual open letter that he believes we are on the edge of a fundamental reshaping of finance. They actually demand for greater disclosure from all firms on carbon emission and climate risk. So I think to continue on the same topic, it means that to comply with all those investment strategies, firms will need to have a better process, data, and to be able to support all that decision making. Isabelle, I'd like to go with you on that topic and see, I mean, you work at a fintech. Do you see interest from the investor community or stakeholder on ESG disclosure? What's your take on that?
Yes, I think there is a strong interest for disclosure. I mean, fintech is all about data. So if it's core to what you do, I think you should track it and also quantify your results. I think that ESG metrics at a fintech should be complementary to your business. And I'll give an example of metrics we use at Payment Source. So like I said, our mission is to increase financial inclusion. It's really core to what we do. So our objective is to provide a transaction for every Canadian. So yes, we'll track, the number of unique customers we have and also number of transactions. But I think a more unique and meaningful metric we have is what we call coverage. And that's to quantify our impact on financial inclusion, where we look at the transactions geographically. And so we want to serve every Canadian, and that includes those in remote regions. So we're not just trying to serve, where the majority of Canadians live in the core downtown of Toronto. And by doing that analysis of geographic coverage, we ensure that this is the case. So like one analysis that we did was for one of our programs that has been very successful at serving the underserved, and it's our reloadable Visa card program. And by looking at this coverage metric, we identified a community in Northern Ontario where 80% of the people in that community were using our card. And that community specifically had no road access. And so the coverage metric really validated that we were on the right path with this program. So, these metrics may seem a bit simple, but I think they do a really good job at quantifying our impact and without being a distraction to our mission and our work.
Oh, okay, it's part of the thinking process. Oh, very interesting. And Anne-Marie, if I wanted to ask you on PSP, I know PSP to integrate the ESG consideration in the investment process. You discussed that earlier. What are the metrics that you look at in your analysis? And as a firm, do you also provide disclosure on your responsible investment activities?
Great question. A lot to unpack there, but if I take them in two parts, so we do look at metrics, and our ESG integration process is anchored on the idea of materiality, which is basically identifying these ESG categories that can have a material impact on a company's financial or operational performance. So in order to help us identify material categories of ESG risk that are relevant at the industry level, we use market-based standards such as the Sustainable Accounting Standards Board, for example, or SASB. And what's interesting about that standards, these standards is that they are increasingly also referenced by corporates in their disclosure to provide additional level of transparency that can enable investors to objectively measure performance on ESG issues and move away from the narrative into generating data-driven insight. And that's a very, very important part of our process. And also on climate change, we do believe that it is a long-term structural trend that is likely to have impact on financial risk across geographies, sectors, and asset classes. So we do integrate a climate-related financial risk as part of our investment due diligence process and also asset management process. And so that's really covering more of the metrics in the investment analysis portion. And in terms of reporting, we do report annually on our responsible investment activities in our annual report, where we provide an overview of our framework, but also some case studies that showcase some examples of ESG integration alongside fundamental analysis in our different asset classes. And we also provide some details on our proxy voting and engagement statistics. But as signatories to the Principles for Responsible Investment, we also respond to the PRI questionnaire on an annual basis that provides a lot of granularity on the on our different practices across the different asset classes. And last but not least, we are also supporters of the Task Force on Climate-Related Financial Disclosure. So we are committed to providing disclosure on how we integrate climate-related financial risk into our processes at the total fund level.
Okay, well, and there's a lot of acronyms that you touched there: SASB, TCFD, PRI, and Katie, on that, I know there's no universally accepted set of ESG metrics, and when I started to read on ESG, there's so many acronyms out there. How a company decides which framework to use, can you help us go through that thought process?
Sure, yeah, and we also often refer to it as the alphabet soup of ESG acronyms, which in and of itself is an acronym. So we can certainly, from inside this this practice area, appreciate how confusing and how many different references and guides are out there. I think it definitely speaks to the tremendous interest and the importance of figuring this out, how to account for ESG factors. So the spirit and the intent, I think, is really great. What a lot of the industry is talking about, however, is how to converge, how do you systematize, standardize reporting so that it is fit for purpose across multiple uses, but also reduces the burden on management. And so, because as you can imagine, each of these different reporting frameworks has their own unique focus area or their own unique intent in terms of how to demonstrate what the risks are. So for example, something like the Global Reporting Initiative is more focused on a company's impact on the external factors. So a company's impact on the environment, a company's impact on its employees and local community. Whereas the TCFD, the Task Force on Climate-Related Financial Disclosure, that one is much more focused on the impact of those externalities, so climate risks and opportunities, on the business. How could it potentially put at risk the business's ability to generate value and create value over time? So there's a lot of different interesting, again, perspectives here to take into account, which can be challenging. But what I would say is, you know, similar to what Isabelle was talking about, let's step back for a moment and take all of these different acronyms and their, you know, their indicators that they have. There's probably only a meaningful select few, which really should be the focus of what you can actually do and do well. And so by thinking about what are the key risks and opportunities from a much broader, again, potential selection of topics. And in the fintech industry, you know, there are things about business integrity, cybersecurity, thinking about use of algorithms. So there's a lot of talk these days about bias in algorithms and algorithmic integrity. I would say those are the types of issues that should be the focus of an organization's approach. And then to create metrics which will assist you in tracking and monitoring your performance. At the end of the day, a really meaningful and solid KPI that really speaks to the business's risk is much more valuable than a generic one that doesn't actually relate to any of the business's actual risks, right? And it gets then lost in the details. So I would say, you know, focus in on a small few, reference some of the bigger, you know, the publicly available standards, but use them as a reference point only. You don't need to abide by them, you know, especially if you're just starting out. Pick the most meaningful and perhaps put together a 2 or 3 page disclosure, which talks about your position on these particular topics and risks. And that, in my view, is a really a unique and simple and practical way to come at this. There's another area that I would suggest as well you can take into account. So many GPs as well as others across the investment community, again, institutional investors, they are frequently disclosing what is important to them. What is it that they are making their decisions on, or what are the topics that are of concern? So if you can access their publicly available information and just do some basic research, you'd also be really well positioned to understand, do they consider governance factors in IPO readiness assessments? Do they consider, right, do I need to have somebody on the board? And I know some examples where, again, there are other major investors who have come out and made, public statements that they're not going to bring investee companies public. They're not going to take them public unless they have a woman on the board. So if you have an all-male board and you've done your research, then that's something that you potentially would want to address as a factor of investment attractiveness. So again, being more appealing to a broader investor audience. So I think that piece of the research as well is very important. Understanding where your target investor community is headed and what is important to them will help you to be better tuned into where you need to do some work.
It's a lot to think about and to put on the agenda for the next management meeting. That's great, thank you. I'm gonna still stay in the recent news and the United Nations Principles for Responsible Investment. It's a group of 2,300 institutional investors that represent roughly 85 trillion of asset under management. They stated that many are now calling for a more human-centric model or a new social contract for businesses that would address economic and health impacts as well as inequalities of the current systems. I'm going to start with Isabelle. With this in mind, in what way ESG represents an opportunity for fintechs?
Yeah, I think at an early stage startup, adopting an ESG goal as a mission can be a differentiating factor and also a driving force to defining what you do and why you do it. So an example of that is where I previously worked at TapTapSend. We adopted the mission of sending money to Africa at a cost of 3%, when the remittance standard was at an average cost of 8%. And with that mission in mind, we really built our business model with a low cost structure to allow us to charge only 3% to our customers. And it doesn't sound maybe so revolutionary, but actually the industry standard was the opposite, where remittance companies would determine how much they charge their customers based on their cost. So just by having that mission, we just completely changed the approach, and it guided our approach to partnerships, how we selected partners. We skewed more towards tech-focused partners who would allow us to have a lower cost structure in order to meet that goal. So really our social impact mission was not a distraction, it was core to what we did. It also allowed us to be very focused. We had one goal, which was lowering the cost of remittance. And like every department, every team member was aligned to that objective, and it was really motivating for people. And I'd say the last benefit could also be on hiring practices. So it's a great way to attract talent, which is often a big challenge for startups. And if you think about the amount of hours that employees spend at work, it can help differentiate you from larger companies by offering them that purpose.
Oh, very, very interesting. And I think all those initiatives that are being pulled by different companies at different level, I feel like this is also creating a lot of data in this system, a lot of data to aggregate and interpret. And Katie, on that, I mean, when we talk about data, that data is key for investment decision and for the ESG analysis to be relevant. How do you see your clients managing that amount of data and assessing this data. I feel like there's a lot of risks involved in relying to certain available data. I'm curious to see how we can mitigate those risks.
Yeah, it's a really important piece of this equation, the information, and there's just so many different challenges here, from the variety in methodologies to the differences in jurisdictional and regulatory reporting requirements. There are industry-based organizations which have issued their own industry indicators, and so again, part of it goes to the framework question, which we dealt with earlier. But from a data perspective, yeah, there are equally important challenges here. And in a recent survey that Kpmg had done in 2020 with institutional investors and hedge fund managers, the institutional investor group indicated that 49% of the 135 global entities surveyed lack consistent quality data is kind of the one big issue that they're facing. It's almost 50%. And hedge funds even higher, 63% said that their processes are in some way hampered by lack of robust and detailed information. So the way that we see companies trying to overcome this, I would say, is to help bring ESG out of the spreadsheet, first of all. A lot of this data has been managed, often, I would say, by great in-house specialists and operations teams who are managing the real estate, for example, of a company's real estate holdings or operations or manufacturing, and who really have, again, the experience and understanding what good data looks like and how to produce good data. But it's actually quite different than from a financial reporting perspective view. So the thing that we are seeing in terms of the trend is for finance to become more involved in the ESG data process, from generation, collection, and reporting. Because the finance team is so much more accustomed to internal controls for financial reporting, those same principles can be applied to ESG data and information. And it typically hasn't been before, as I mentioned. There's typically limited oversight and review. There isn't a lot of periodic control testing. Even the design of the controls is likely less than what you would expect to see. Now that this information is being used for investment decision making, the importance of having robust and high quality data increases. So on the corporate side, we see corporates moving much more towards including their finance teams in the reporting of ESG information, and also seeking assurance. Again, it's they engage a third party to come in and provide an opinion, and that as well gives some comfort that the information that is reported is of high quality. And that in turn, from an investor perspective, is as well very appreciated and highly valued. We've seen some interesting things over the years that sometimes, comparably speaking, there are really significant data errors, and assurance is something that can help to mitigate those factors. And as this information starts to migrate into the standard and traditional financial reporting, the annual report, which is something that we are seeing as a trend, the importance again just increases to ensure that the data is good.
So still a lot of investment to be made in this field.
Yes. And learning from those that have the experience internally. So it's just bringing those worlds together.
Absolutely. And Anne-Marie, PSP has its own process to monitor the public market's ESG metrics. And how do you see your current process evolving in the future?
Yeah, we've seen that actually for over the past 12 months or so. We've developed some new tools, for example, that help us analyze and compare publicly listed companies on the quality of their corporate governance practices. And I thought it was interesting. I was listening to Cathy that our intention, our goal really was to leverage the information that we could find in proxy research, as an example, in proxy circular, and transform what is essentially a qualitative data stream into a quantitative data stream. And what we thought was particularly interesting in that using the data from the proxy voting process is that it is market-based. So to your point about geographic differences, the methodology add the merit of being relevant and also comparable on a geographic and market basis. So as an example, we're now able to aggregate quantitative data on certain governance criteria that are applicable in a listing market. And based on that information, we're now calculating average corporate governance scores for portfolios that are internally and externally managed and comparing them against their respective benchmarks to identify outliers. And also another very interesting element of that is that we're able to capture the rate of change in the underlying scores of the companies in each of the portfolios, and also identify trends in governance momentum that can help guide our engagement activities. Looking to the future, that we're still seeing a lot of innovation on ESG data, partly because there's still imperfect disclosure on the corporate side, and also because we talked about materiality earlier, but the materiality is a dynamic concept, so it may change over time as a result of changes in regulation or stakeholder perception. So it was very important for us in our scoring methodologies to also integrate a flexible approach. So we've been onboarding some alternative data sources, for example, that are powered by artificial intelligence to scrape different media sources across different languages and get a dynamic view of how ESG risks are becoming material for certain companies in specific markets or sectors based on stakeholder perception. And we also found that these new tools are very helpful in also assessing the level of positioning of companies towards sustainable opportunities. We're seeing, for example, a lot of new products being developed in green technologies, energy efficiency technologies. So these alternative data sets are helping us monitor news flow about specific companies that can give us a pulse or a sentiment gauge on how they're positioned to capture opportunities in new markets. And lastly, we also use these data sets to provide some early signal on potential ESG incidents, because oftentimes these incidents don't occur in isolation and they tend to multiply over time. So if we're able to identify new trends, it's also valuable information we can integrate in our investment process.
Oh, and a lot of innovation that's really relevant for our
likely to continue as well.
For sure. And I know we do have several startup fintechs that are attending today, and some of you have may read in the news in November 2020, Canada's 8 biggest pension funds, and that's a group representing around 1.6 trillion of AUM. They threw their weight behind global efforts to try to improve corporate sustainability reporting, and they're urging companies and also their investment partners to report more ESG data in a standardized way. The statement, they wrote in the statement how companies identify and address issues such as diversity and inclusion, human capital, board effectiveness, and climate change can significantly contribute to value creation or erosion. So that's a big statement too. And they encourage companies to use Sustainability Accounting Standard Board, so the SASB that we discussed earlier, or the Task Force on Climate-Related Financial Disclosure, the TCFD framework, to further standardize the ESG-related reporting. And I'm gonna go to you, Isabelle, because you've been in a startup. You know how raising capital is critical in the first stage of a startup. And most of the time, the startup also have limited resources internally. So in your view, how can a startup integrate the ESG principles to be appealing to investors?
Yes. So as you said, Mark, impact investing is not just a trend anymore. There's significant capital available. And so I think that having an ESG focus can help you in your fundraising, in that you not only have access to VC funds, but you can now also attract those impact focused VCs. So it just gives you potentially access to more sources of capital. That being said, what's most important for a startup is having, the strong team, the great product, and showing traction. And to achieve that, you have to be very focused. So unless the ESG target is core to what you do, I wouldn't recommend going in that direction. It's not just a tick the box exercise. And VCs expect that. So you have to be authentic, and impact focused VCs are going to be very serious about quantifying the impact of what you do, and they'll hold you accountable to that claim. So let's say that you're trying to build, a challenger bank, and your ESG angle is, oh, I'm just going to offset my carbon footprint by planting trees. There's no link to those two missions, right? And so a more logical connection would be a company like Daylight, which is a digital banking platform, which is built for the LGBT plus community. So what they're doing is they're building, social equity by providing banking services adapted to the community they serve. That's more meaningful. And, the theme of social equity is not a distraction from what they do. And I think that what impact investors are looking for is that more natural connection. So that's how I think the ESG can play in the fintech fundraising.
Great. And no, because that's really important too, to align with those large institutional investors' demand too. It's important to keep that in mind. And Katie, you touched on that a little bit earlier on how ESG can be managed internally, but who is generally responsible in the organization for identifying and managing ESG? And how do you see this being integrated or implemented in a startup with limited resources?
I think it typically was a centralized role where one person would say, ESG, I've got this covered. I'll respond to all of our requests and questionnaires. And we've seen, I think, quite a shift in the last couple of years. And I think this applies well to startups as well. But the decentralization of this really speaks to what Isabelle was talking to about alignment with business. So rather than seeing ESG factors as something that is separate to the business, it's really just thinking about the existence and the purpose of the business, and then identifying what are those natural risks and opportunities, and where do they sit within the organization. So for example, the top, leadership and tone from the top is crucial to have this succeed, but it also requires tremendous support from human resources. Who are the people that you're going to be bringing into this business? Are you going to be outsourcing certain elements? If yes, do you have standards that you expect those outsourced employees to receive in terms of labor practices or benefits or safety? There's a critical link with regulatory affairs, given the multiple regulatory developments, particularly on climate environmental factors. Brand and communications with regard to reputation. Again, the authenticity factor needs to be very much connected to what you are presenting your business face to the world. I would say investor relations. Having the investor, whoever is interacting with your investors, need to fundamentally understand ESG for your business, because increasingly investors are bringing this into the conversation. Procurement, another one, again, just due to the fact that there's a lot of potential ESG risk from a supply chain perspective. And we've seen, modern slavery acts be developed in Australia, in the UK, those, and very probably will be here in Canada as well in the near future. So having a broad, again, and open perspective about what the potential ESG risks are, and then looking across the organization for the individuals who manage various aspects of those and can really take ownership over those and drive initiatives forward. But again, this is, I think it's rather intuitive once you think about it. Diversity, equity, inclusion, it's something that is core to the HR function. And most HR organizations right now are very active in this. So bringing that alignment together is a really excellent opportunity. Going back to something that I said earlier as well, just when we're thinking about particularly fintechs and the role of technology and innovation, the ethical layer or lens that we're seeing being applied to technology and innovation in particular, due to the potential unintended consequences or impacts in the design phase, that to me is a very unique but highly applicable to the fintech sector, to ensure that the products and services that you are developing and offering have been assessed, at least using an ESG lens, to ensure that there isn't any bias or prejudice embedded in the technology, in the algorithms, in AI. We've seen it again time after time. These examples where inadvertently, because this risk lens hasn't been applied at the outset, this is, again, it's happened from time to time, and we're seeing more and more cases of it. So I think that is a really important topic for startups as well to be aware of and to embed in the early days of design as well and growth.
Oh, I like the tone at the top concept. It's really key. On our last subject for today, I see that the time running. There was a survey to Canadian CEOs that said that COVID-19 pandemic has shifted their focus more on the social component of ESG. I was curious to know, Anne-Marie, have you noticed a shift in stakeholder focus on ESG issues in recent months or related to the pandemic?
Absolutely, and I think we touched on a lot of these topics previously, but a rising focus by investors on employee health and safety, but also labor practices across the supply chain, which can include working conditions, but also working hours and decent wage. We're also seeing a further focus on the alignment between executive compensation and the measures of performance on these particular elements of employee health and safety. And as an example, in this proxy season, we're seeing a lot of attention being placed on either one-time grants or annual bonus payments that are done in alignment with the treatment of the broader workforce throughout the pandemic. For example, taking into consideration whether there were significant layoffs, and also the level to which the companies have supported financially and through benefits their employees throughout these challenging times. So definitely we've seen the S pillar rise in importance, and also continues to be a priority, but heightened focus, I would say, on diversity, equity, and inclusion, not only at the board level, but also throughout the organization, and really making that distinction between diversity at the representation level, but also how that's integrated in corporate culture through equity and inclusion.
Okay, no, that's interesting. And Katie, as part of that, the pandemic, and currently, do you see in the marketplace an accelerated adoption of the responsible investment thesis, or Do you see any specific change in the market?
Yeah, I mean, I think it's been really fascinating from the perspective of it has almost tested our national or global business continuity programs, like at a macro level, because the social safety net, like the expectations, which probably traditionally everyone thought, well, that's in the government's purview. They've got the programs for stimulation and hold, they're the kind of the masters of that area. But I think what we actually saw as well was a big shift of that responsibility to business. That it isn't unique, the social safety net responsibility, that it isn't uniquely held by, by our public institutions and or civil society. But business plays a really critical role in this. And so I think that has reinforced the importance of ESG, and it certainly has drawn, I think, a highlight on some things that we saw through the pandemic, like weaknesses in global supply chains, disruptions, surging customer demand for critical goods, and things like social access. What about people who are isolated? How do we get them food? How do we keep them connected to healthcare? So I think, again, there's been a lot of very, unfortunately, positive things that have come from this in terms of what we have learned and what businesses have learned about their ability to contribute to society, particularly in times of crisis, and that businesses play an incredibly important role in maintaining the continuity of our, economic stability and prosperity and function. So even those industries that were somewhat insulated from the impacts, I think they're still seeing the, even in some shape or form, some of the health and safety impacts, or just more broadly from retention and mental health and mental wellness through the pandemic. So I think there's a lot of really interesting things that business and society at large has learned through this experience.
Absolutely, we all lived it for sure. And Isabelle, I'd like also to get your thoughts on maybe diversity, and how do you see this as being a source of innovation and transformation for organizations?
Yes, I think that a diverse workforce can be a source of innovation. You just don't know where the next great idea will come from. And especially as a fintech startup, you're looking to build something and disrupt the status quo. So I think a diverse workforce can help you get there. Like if you have, a group of engineers looking at a problem together, they're probably going to come up with an engineering type of solution that will involve some coding. But what if you bring in your customer support team on that? They're going to look at the problem in a completely different way, and it will likely be more from the customer's perspective. And so the solution to that same problem would not be coding, but would be a new product feature, or a how-to guide or whatnot. So different groups of people will come up with different solutions to the same problem. So I think that's what bringing in diversity is about. And I think as a startup, you have the opportunity to define what you care about, like your values. And so it's a lot more challenging for large organizations who are now looking to change or adopt some ESG goals. And so if as a startup, you adopt diversity as a value in your early stage, it will ensure that you build in the hiring practices to allow you to achieve that goal. And so an example of a practice that we have at Payment Source is we've created an ideas committee where employees from all departments can propose changes and processes, changes to processes, or even sometimes some new products for us to build. And without really talking about what we're building right now, we've received ideas from all departments and all levels through this program. And you know, when you think of diversity, it also means differences in opinions and background. And I think that fostering a diverse and collaborative environment is the key to innovation.
Oh, that's very inspiring. And it's maybe just a couple words to wrap up our panel discussion of today. As you can see, I think it's pretty clear that the types of risks that organizations are facing are evolving a lot. And when you just look 10 years ago, the economic risk dominated the global risk report that was issued by the World Economic Forum. And when you look at the 2020 report, 8 of the 10 risks by extent of impact are related to ESG issue. It's a really strong statement from the market. And from what I understand in today's discussion, I think ESG needs to be a strategy that is now key to all financial institutions and fintechs, and it has to be in their DNA. I think also bank will need to take a step back and think about their relevance and role in society and economy. That's a lot of opportunities for fintech too. And as a fintech, you should ask yourself, how can we leverage ESG to strengthen our business? What influence do we want to have? How can we be truly bold and create something that will both differentiates us and reflect the values of our organization? But I think the most important question will also be, where do you see yourself in the spectrum, as a leader, a fast follower, or just doing enough? So that wraps up our discussion today. I hope you enjoyed. Thanks for having us today. Thanks to my panelists. It was really inspiring, very interesting to hear your views on the subject. I don't think we had any questions in the Q&A box, but I'm gonna pass it to Mathieu for the closing.
Thank you, Marc, Isabelle, Anne-Marie, Katie. Thank you so much for being here today with us and sharing this amazing insights with the community. We're gonna have another event in French this time on May 13 about how to make Montreal a center of excellence in IA and machine learning and AI, sorry, and machine learning in finance and asset management. So make sure to visit our website to have a look at the program for this event on May 13. So thanks again, and it was a pleasure for me to listen to you this morning, and I hope we'll be in touch very soon. Have a good day.
Thanks, everyone. Bye-bye.